Gold just hit $4,350 an ounce.
Yeah, a massive, massive milestone.
Right. And the world has essentially been holding its breath, waiting for the next geopolitical shoe to drop.
Oh, absolutely.
And yet the biggest institutional investors on Wall Street are currently just, well, they're sitting on their hands.
Yeah, they really are. Welcome in, everyone, to another deep dive. Really glad you could join us today.
Yeah. Thanks for tuning in.
Before we get into the thick of it, if you find this kind of breakdown helpful, make sure to hit that like button, subscribe to the channel, and definitely drop a comment with your thoughts down below. It really helps us out.
It absolutely does.
So today we are unpacking the morning gold and silver market news for June 17th, 2026. And to help us sort through all this, I'm joined, as always, by senior market analyst Michael Anderson.
Great to be here. We've got a lot to cover today.
We really do. So I want you to imagine, just for a second, walking into the world's most high-stakes, exclusive casino.
Oh, I'm picturing it.
Right. So the lights are flashing, the tables are completely open, dealers are ready. And here's the weird part. When you look around, nobody is actually playing.
Just total standstill.
Exactly. Everyone is just standing there. They've got their chips tightly clutched in their hands, staring silently at the pit boss, and they're just waiting for him to blink.
That is a remarkably accurate way to describe the market this morning.
Right. That eerie high-stakes paralysis, because that's exactly what our sources are showing us today. We're looking at a market that has just violently hit the pause button.
Yeah, it's shifted from this, panic buying frenzy into a really tense position-waiting state.
And our mission today is to figure out why. The sources we have are, they're pretty dense. We've got hard market data, macroeconomic analysis, and some really specific strategic recommendations.
And, they all point to that exact phenomenon you just mentioned. The goal here is to really connect the structural dots between cooling oil prices, the U.S. dollar, and, of course, the looming shadow of the Federal Reserve.
Always the Fed.
Always. We need to look under the hood to see the mechanics of what's actually driving your portfolio into this holding pattern. Because, and this is crucial, this is a technical correction. It is not a panic sell-off.
Okay, that's a huge distinction. And to really understand the mechanics of that correction, we've got to start by looking at this violent divergence happening between our two main metals this morning.
Yeah, gold and silver are, they're living in two completely different realities right now.
Totally different. So let's look at gold first. Gold was riding high, right? Making these aggressive attempts to hold that $4,350 an ounce mark.
Right, the 4,350 level.
But during the morning session, it just structurally failed. It couldn't hold the high, and it slipped down into the $4,320 to $4,330 range.
Which is significant. I mean, we saw a $30 volatility range in just that single session.
That's a huge swing for one morning.
It is. A $30 swing within a few hours indicates a severe battle between buyers and sellers. I mean, when gold repeatedly fails to break a ceiling like 4,350, the algorithmic trading systems...
They just take over, right?
Exactly. They automatically flip from buying the momentum to shorting the resistance. And that triggers this cascade of short-term selling pressure.
But it didn't completely crater.
No, it didn't. And what's vital to understand here is the psychology of the floor. That $4,300 level is acting as a massive support zone.
Because that's where the big money steps in.
You got it. Large institutional buyers have limit orders stacked right at that price. They see it as a baseline value, so it creates the safety net that essentially stops a full-blown rout.
Okay, that makes total sense. It hit a floor where the big funds decided, the discount was just too good to pass up.
Right.
But then you look over at silver, and it is completely ignoring the drama.
Silver's just having a quiet day at the office.
Seriously. It's just cruising along, trading sideways between $69.50 and $70.50. As we're sitting here right now, it is parked perfectly at $70 an ounce. Totally unbothered. It actually made me think of this analogy. Right now, gold is acting like this high-strung, nervous sprinter, reacting to every single headline, every gust of wind.
And silver.
Silver is the marathon runner who also has a steady, demanding day job keeping them grounded.
That is a great way to put it. And that day job is literally its salvation in a volatile market.
Because of the industrial side.
Exactly.
Yeah.
Silver isn't just a financial instrument. It's not just a speculative safe haven. It has massive, completely inflexible, industrial demand.
Right, like solar panels and stuff.
Solar panels, electronics, electric vehicles. The manufacturers producing these things, they require physical silver to keep their assembly lines moving.
They can't just stop building cars because the chart looks a little shaky.
No, they can't. They have to take physical delivery.
Yeah.
So that industrial mandate creates a hard floor underneath the speculative paper market.
Which stops it from crashing.
Right. It prevents silver from experiencing those same drastic, sentiment-driven drops that we see over in gold.
And the reason this divergence really matters to you listening right now is what it signals about the broader market.
Yeah, the underlying health of the sector.
Exactly. When gold stumbles, the immediate fear is always, oh no, the bottom is falling out of the entire precious metals group.
Total panic.
Right. But silver's structural stability actually proves that the money hasn't completely withdrawn. Investors aren't, fleeing in a blind panic, dumping everything shiny.
No, they're really not. They are just pausing their aggressive buy orders for gold while pretty much maintaining their overall positions.
Which leads us directly into what I think is a massive macroeconomic contradiction.
The broken rules.
Yes, because when we look at the broader data driving this pause today, the traditional rules of wealth preservation, they just seem to be malfunctioning.
I'm so glad you brought that up.
Good, because my brain was literally flashing a giant error message while I was reading through the macro data from the sources today.
Let's break it down.
Okay. Economics 101 gives us a very simple equation for gold. Let's look at the actual numbers we have today. The US dollar index weakens slightly, right? It's sitting around 99.57 points.
Yep, a slight dip.
And U.S. 10-year Treasury yields cooled down a bit too, dropping to about 4.435%.
Also true.
So traditional economic theory says that because gold pays no interest, it has to compete with assets that do.
The whole yield argument.
Right. So if the U.S. dollar drops and bond yields go down, meaning the competing safe havens aren't paying out as much, gold is supposed to skyrocket.
That is the textbook rule, yes.
So why on earth is gold stuck in the mud right now with these textbook ideal conditions? It makes no sense.
It comes down to the brutal reality of opportunity cost in an inflationary environment.
Yeah.
You really have to look at the magnitude of that yield, not just the direction it's moving.
Okay, explain that.
Yes, the 10-year Treasury yield cooled down to 4.435%. But a guaranteed risk-free yield of almost 4.5% from the United States government
is still huge.
It is structurally massive.
It's kind of like, tell me if this analogy tracks. It's like choosing between putting your money into a savings account that pays you a guaranteed $400 a month versus taking that exact same money and buying a plot of vacant land.
I like where this is going.
Right. So sure, the land or the gold, in this case, it might double in value in 10 years, but it pays you absolutely nothing today. In fact, it just sits there.
Right. It just costs you money to secure it.
Exactly. So right now, that 4.4% Treasury yield is the guaranteed $400 a month. The opportunity cost of leaving that guaranteed money on the table is just too high for large funds to justify moving heavily into zero-yield gold.
That vacant land analogy perfectly captures institutional thinking right now. The opportunity cost of holding gold has decreased slightly, sure, because yields dipped.
But not enough.
Exactly. It hasn't dropped anywhere near the threshold required to trigger a massive influx of capital. And to compound that friction, we have to examine what our sources call the oil chain reaction.
Oh, yeah. The bond yields are keeping money away from gold. But the energy sector is actively destroying the fear that normally drives people to buy gold in the first place.
That is the real kicker here.
I tracked this oil chain reaction in the analysis, and it looks like a complete domino effect. So Brent crude slipped to around $80.40 a barrel.
And WTI is roughly $76.70.
Right. And for anyone listening, the absolute dollar amount here matters less than the psychological and algorithmic thresholds.
Yeah, it's about what the numbers represent.
Breaking down toward that $80 mark, it signals to institutional models that global supply constraints are actually easing.
Right. And when those algorithmic models see easing energy costs, they immediately rewrite their forward-looking inflation forecasts.
Because everything runs on oil.
Everything. Energy is the absolute bedrock of the global supply chain. Lower oil means the cost to manufacture goods drops.
The cost to load them onto a cargo ship drops.
Exactly. The fuel to truck them to a retail store drops. When the broader market realizes the structural cost of doing business is getting cheaper, the panic demand for a safe haven asset like gold just evaporates.
Because the fear is gone.
Right. People aggressively buy gold When they are terrified, their fiat currency is becoming worthless due to inflation. If inflation is visibly cooling through the energy sector, that terror naturally subsides.
Which means, and this is a big pivot, it means the Federal Reserve might not have to be the bad guy anymore.
Yep, the pressure is off.
If inflation is fixing itself naturally through cheaper energy, it takes the heat off the central bank. And that brings us to the absolute center of gravity for the entire global market today.
The pit boss in our casino.
The pit boss, the FAD.
Yeah. Every other data point we've discussed so far is essentially secondary to how the market is anticipating the Federal Reserve's monetary policy direction.
It's all anyone cares about. The sources make it super clear that the market has completely priced in the fact that the FAD will keep interest rates unchanged tonight.
Right, the actual decision is already baked into the cake.
It feels exactly like sitting in a movie theater. The movie playing right now on the screen is tonight's rate decision.
But nobody's watching the movie.
No. The audience is completely ignoring the screen because they are entirely focused on analyzing the trailer for the sequel.
That is exactly it.
Nobody cares about today's data. They only care about the forecasts for the coming months. Are they taking a soft stance or are they promising pain?
And the anticipation of that sequel is what is physically freezing capital flows right now. The primary debate in the sources focuses heavily on December.
What's the consensus there?
Well, the broader market consensus currently predicts a greater than 50% probability that the Fed will increase rates again in December.
Over 50%. But one of our key macroeconomic sources actually pushes back on that narrative entirely.
They do, yeah.
They argue that a December hike is highly unlikely, and their reasoning hinges entirely on that oil chain reaction we just talked about.
It's all connected.
If energy-driven disinflation is already doing the heavy lifting of cooling the economy, the Fed doesn't need to risk causing a recession by forcing another aggressive rate hike.
Exactly. So let's map out how that translates to your portfolio tonight. Because the market is essentially staring down two binary scenarios.
Okay, give me scenario A.
Scenario A is that we get a softer than expected FAD statement. They acknowledge the cooling inflation and hint that the hiking cycle might actually be over.
And the market reaction.
The mechanics are immediate. Yields will violently drop because future bonds won't pay as much. The U.S. dollar weakens.
And suddenly your vacant land or gold looks vastly more attractive.
Right, because the savings account isn't paying out $400 anymore. In this scenario, gold rallies hard.
The casino patrons finally throw all their chips on the table.
Bingo.
But then, obviously, there is scenario B.
Scenario B is a harder than expected FAD. They come out hawkish, explicitly warning that core inflation remains sticky despite the dropping oil prices.
And they leave December on the table.
Right. They affirm that December is absolutely a live option for a rate hike. If that happens, the pressure physically crushes the gold and silver markets as the algorithms just rush to lock in higher bond yields.
Because the guaranteed money goes up.
Exactly. And because large institutional fund managers know that a single sentence from the Fed chairman could trigger either of these scenarios.
They do nothing.
They refuse to move. They sit in cash or short-term money market funds and just wait.
So if gold is paralyzed waiting for the Fed, that institutional cash doesn't just sit in a vacuum forever, right? It gets restless.
Very restless.
And because oil is getting cheaper, we are actually seeing that restless gold money start aggressively eyeing the stock market.
It's the ultimate double-edged sword for precious metals.
How so?
Well, lower oil prices destroy the safe haven demand for gold, but they actively supercharge corporate equities.
Oh, because of the profit margins?
Think about it. When a massive logistics company or even a retail giant suddenly pays 20% less for fuel, their profit margins artificially expand.
Without them having to sell a single extra product.
Exactly. Corporate earnings start looking fantastic across the board.
So suddenly, the stock market looks like a highly attractive competing destination for all that investment cash that used to hide out in precious metals.
Yep. Why hold zero-yield gold, hoping for disaster, when you can buy into companies that are actively benefiting from cheaper energy today?
It is so fascinating to me that objectively good news for the world, like cooling oil prices and a recovering economy, is the exact mathematical mechanism putting a hard ceiling on your gold portfolio right now.
It is a ruthless reallocation of capital based purely on shifting margins.
Yeah.
And there's a final layer to this holding pattern, which is deeply tied to geopolitics, specifically the U.S.-Iran situation.
Now, to be completely clear to our listeners, we analyze this strictly through the lens of market data and supply chain mechanics. We are removing the politics entirely. We don't take sides on this.
Absolutely. Yeah. Just looking at the numbers. And the sources indicate that the market considers an agreement between the U.S. and Iran to be highly likely, but the final implementation remains very uncertain.
Right, so let's look at the physical mechanism of why that matters to the gold market.
Okay.
If an agreement passes, millions of barrels of Iranian crude that are currently locked out of the official system will legally flood into the global logistics network.
A massive supply shock.
When you dramatically increase the supply of oil, the price crashes further. The algorithmic inflation models drop again, stocks go up, gold goes down.
It accelerates that whole cycle we just talked about. But conversely, if the deal falls apart at the last minute, that anticipated supply just vanishes from the models.
And then what?
Oil spikes, inflation fears instantly return, and safe haven panic reignites the gold rally.
So it's basically a coin toss.
Yeah. In the financial markets, a situation that is highly likely but uncertain is the ultimate recipe for paralysis. Investors will not place multi-billion-dollar bets in either direction until the ink is dry.
Wow. This combination of factors creates what one of our sources brilliantly termed the golden stagnation.
I love that phrase.
It's perfect. The market is not lacking news, it is drowning in it. What it lacks is confirmation. Without a clear, mathematically defined macroeconomic trend, massive institutional money simply sits on the sidelines.
So the overarching question then becomes, how do you actually navigate a market that is actively refusing to take a direction?
Right. Let's translate this high-level theory into the practical, actionable strategy outlined by our sources, starting with the immediate short term.
Let's do it.
The short-term consensus from the sources is a mandate to expect continued tight sideways fluctuations.
Choppy waters.
Very choppy. For your immediate technical levels, you must watch that critical support zone between $4,300 and $4,320.
That is the absolute line in the sand right now.
And on the upside, institutional resistance is sitting heavy between $4,340 and $4,360. Until one of those bounds breaks, we are basically trading in a cage.
Yeah, we're stuck. But looking further out, the long-term view requires a bit of perspective.
Don't panic, basically.
Right. It's really easy to look at a stagnant day and panic that the golden age of precious metals is over. However, the sources confirm that the overarching long-term structural upward trend for gold remains unbroken.
The trend is still your friend.
Exactly. The fundamental structure is intact, but the rate of increase will dramatically slow down.
So no more overnight rockets.
Probably not. The explosive, panic-driven rallies of the past year are likely behind us. We're eventually transitioning to a slower, grinding climb, supported by shifting capital flows, when monetary policy inevitably softens.
Our sources also included some very specific warnings for anyone actively trading in this environment. They explicitly warn against chasing price pullbacks.
Do not try to catch a falling knife.
Exactly, and they heavily emphasize the dangers of excessive leverage right now.
Oh, leverage right now it's incredibly dangerous. The mechanics of leverage in a sideways market are brutal.
Walk us through why.
Well, when you use leverage, you are essentially borrowing a massive amount of money to bet on tiny fractions of price movement.
Right.
But because everyone is waiting on the Fed, overall market liquidity essentially dries up. There are far fewer active buyers and sellers in the market.
And when liquidity dries up, things get weird.
They get volatile. The gap between what a buyer wants to pay and what a seller will accept, which is known as the bid-ask spread, stretches out significantly.
So more expensive just to enter a trade.
Yes. And worse, if a sudden news headline hits about Iran or inflation, the price can gap violently through that thin liquidity.
Oh, wow.
It instantly triggers margin calls and liquidates your leverage bet before you even have a chance to log into your account and react.
That is a critical mechanical warning. The strategy for today, distilled down for you listening, is simple. Don't be a hero.
Please don't.
You do not have to outsmart the algorithmic trading bots, and you do not have to outguess the Federal Reserve.
Nobody can outguess the Fed.
Right. Sometimes the most active, strategic choice you can make for your wealth is to just step back. Preserve your current positions, ensure your portfolio is diversified enough to handle either a hawkish or dovish surprise, and refuse the temptation to perfectly time the post-FA reaction.
In a market characterized by tension, rational observation is your greatest asset. The global financial system itself is taking a breath. It's recalculating its inflation models, reevaluating its pace.
So we should too.
Exactly. As an investor, your portfolio management should reflect that exact same patience. Let the multi-billion-dollar institutions fight it out and absorb the volatility once the Fed finally releases its statement tonight.
All right, let's bring this all together. We started with the image of a high-stakes, paralyzed casino, and we've unpacked the exact mechanics of why the chips aren't moving.
We covered a lot of ground.
We saw gold stumble and fail to hold $4,350, while silver proved its resilience at $70, anchored by the unyielding physical demands of industrial manufacturing.
A marathon runner.
Right. We stripped down the textbook economic rules to realize that a guaranteed 4.4% bond yield is currently outcompeting the speculative allure of zero-yield gold.
And we trace the oil chain reaction.
Yes, seeing how cheaper energy physically alters algorithmic inflation models, taking the pressure completely off the Federal Reserve.
Which is the big story.
Hovering above all of this sidelined cash is the central bank itself, keeping the global economy trapped in a holding pattern as we all wait for a whisper about December's interest rates.
Understanding those underlying mechanisms provides a really profound advantage over traders who merely react to surface-level price drops.
It's about seeing the matrix.
It really is. And, as we leave you to watch the charts today, I want to pose a final lingering thought that kind of challenges the very foundation of wealth preservation.
I'm intrigued. What is it?
Well, we are watching massive amounts of capital potentially pivot away from gold and into the stock market simply because algorithmic models suggest oil is cooling and the Fed might soften its tone.
Right.
It highlights a strange evolution in the modern economy. In a world where central bank whispers, highly manipulated inflation models, and tiny shifts in treasury yields dictate the movement of trillions of dollars.
Right. Are traditional safe haven assets losing their historic sovereignty?
That's the question. Consider the implications. If the ultimate safety in the modern financial system is no longer a physical piece of metal, but rather the ability to successfully predict central banks' policy breadcrumbs, what does that mean for the long-term future of physical commodities?
That is a staggering realization. Is the shiny metal actually the ultimate safe haven, or has the central bank narrative become the only reality the market respects?
Something to chew on.
Definitely. Well, thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking past the headlines to the mechanics underneath, and don't forget to like, subscribe, and comment below. We will see you next time.